Hello. Hey everyone, we're just getting connected here. Looks like Cherie's connecting her audio, so we'll get started in a few minutes here.
Okay, everybody. Hello.
Hello,
Say
hello.
something, Brian, so I can hear you. Yes. Hey.
Thanks for having me. Yeah, and thanks everyone for joining us tonight.
Absolutely. All righty, everybody. Well, look, my um, computer just totally broke down last Sunday. So your girl is pushing things together with her backup laptop. So, but the Geek Squad said it'll be done hopefully by Wednesday. So we want to thank everyone for being here with us this evening. And we're just going to make things makeshift until. So don't forget to put your city and state in the chat. I see here Robin from Rancho Cucamonga. So hello, California. I see Kent, Washington here in the house. Then Tacoma, Washington, a lot of West Coast today. Colorado is in the house. Let me say, and I feel your pain with the crashed laptop. Yeah, so, okay, so my desktop, that's like my all-powerful editing, all of the most efficient thing, just, yeah. So this is the backup laptop, and of course it has no power to it, no real juice, and I refuse to spend $1,200 on the super laptop. So just I see Atlanta in the house. I see Jacksonville, Florida, Suffolk, Virginia, San Diego, another California, San Leandro, Jacksonville, Florida. We got Atlanta, Tennessee, Kansas, Barbados, DC. Hello, everybody. Welcome to the 10K Project. We are the largest community of small dollar investors who actively fund Black-owned businesses. And when we get together, we start funding our own businesses. We don't have to wait for the big boys, those venture capitalists that give us less than 1%. We don't have to wait for them to fund our businesses. We can start funding our own businesses, profiting from our own innovation, creating jobs, and working together to build Black wealth. And we have a special guest, very supportive gentleman, Mr. Brian Belley here from Crowdwise. He is here today because he is, first of all, one of the nation's greatest thought leaders and educators with regards to crowdfunding. He is one of the guys that not only teaches the history of crowdfunding and how we can be smart and smarter investors, but he also, I believe, even lobbies on behalf of crowdfunding, on behalf of the investors and the entrepreneurs as well. And during our last conversation with you, Brian, you mentioned at the time that you had invested in over 130 equity crowdfunding deals. What's the number now?
I checked it just before the call tonight, Cherie, and 159 is the current number.
159. So. All right, so when we put our YouTube recording up, it's going to be 159. Okay, so I thought today would be pretty interesting for us as investors to learn how somebody like Brian has actually built his portfolio, what he looks at. Many of you know that we do our Bet on Black Pitch every Tuesday at 8 p.m. Eastern Time. And then you are also able to go to the website, the campaign website. You're able to read the Form C. Tawana is always educating us about that, et cetera. So, Brian, I would love for you to introduce yourself to everybody. And then I'm going to put myself off camera just for a couple of seconds, let the dog in, but introduce yourself and talk about how you got into equity crowdfunding.
I'd love to. And I just want to thank again you, Shuri, and everyone at the 10K Project for having me tonight. And welcome to all of you out there, whether you're investors, which I think probably a lot of you are, or entrepreneurs who are working really hard yourselves. So my background is interesting, and I say that because I didn't come from a startup background, from having a financial background, from kind of doing any of this. My day job was as an engineer, so I worked as an aerospace engineer for 10 years. But all that time, I have always had a passion for investing, and so I think I saw Trent, over here. You said you're currently at 6, and hearing 159 investments can sound intimidating, but to be clear, I am definitely an outlier, and I've been doing this for several years now. And to be honest, everyone, you have to start somewhere, right? Like at one point, I had never made an investment in a startup company before, so I was the person who was looking to make my first, and then my fifth, and my 10th, and so on investment. So the way I really got involved, though, I've always been looking for diversification opportunities in my portfolio. So essentially, trying to say, listen, it's great. I mostly invest in, stocks and bonds and real estate, kind of like the typical things. But I've always been looking for kind of that, ability to be able to diversify in something that's maybe a little bit higher risk, but at the same time, much higher impact, right? So when I say higher impact, it's that I know that my dollars, instead of going into, a Facebook or a Google or an Amazon, you're one small drop in a giant bucket, right? Whereas when you're investing in the entrepreneurs, that your dollars, every dollar that entrepreneur gets counts. Every dollar that they get, right, is helping them to build, whether it's their product or their service or their business, whatever it is, and to be able to bring that into the world. And so while I will say, definitely a portion of my investing is financially driven, right? I want to get a good return. But there's kind of this added benefit where, as an investor in these early stage companies, you're supporting amazing, passionate entrepreneurs. You get to be a part of that journey. You get to help them and see them, evolve, and through the thick and thin, and broken laptops and everything else. That's that's the how it goes with entrepreneurs, right? You got to figure stuff out and make stuff happen regardless of what obstacles you come up against. So it's been very exciting as an investor to be able to help people, kind of achieve their mission.
Yeah, and I agree with you too. So many people on here, if you're an early 10K Project member, then you know that this started because I am a business plan writer, and I would see so many entrepreneurs who were not able to raise the funds that they needed in order to start and grow. And it wasn't because they didn't have hustle. It wasn't because they had a bad idea. It was just because they didn't have the network. They didn't have the network. They didn't have the person that could stroke a $300,000 check and get them up and running and started. And one of the linchpins for me was actually writing a business plan for a company, being invited to their pitch, which was probably about 40 people in this very nice, very costly room. And they raised $600,000 in one evening. And all of a sudden I'm like, okay, so instead of, because most of our people, probably you as well, Brian, we can't drop $25,000 each, but we can come together in greater numbers and put in $100, $200 each and ride the wave with that entrepreneur. And that's the point of equity crowdfunding, is to be able to do that. And the returns, according to the CrowdWise research that you've done, the returns can be just as good as actually real estate and typical venture capital, if we build a portfolio. So I want you to talk about that. I want you to talk a little bit from the investor point of view with regards to that.
Yeah, I'd love to. And so, again, as my background as an aerospace engineer, now turned, kind of startup investor, I've always been very data driven, right? So the first thing that I looked at, several years ago when I was starting to get into this space is, okay, regulation crowdfunding, equity crowdfunding here in the US, still pretty new, right? It's really only been around since 2016. If you're looking at, Reg CF and Title III of the Jobs Act, you can invest through something called Regulation A, Reg A Plus, which is higher dollar limits. And that was, a little bit earlier. So I actually did invest in one of those back in 2014. But when getting started, I was like, okay, there's not a lot of data. And to be honest, even today, it's still to be seen because a lot of these companies are only 4 or 5 years into it. And, as most of you know, for any type of real significant kind of exit or, outcome for an investor, you're probably looking at 5 to 7 years on average. And, especially if you're talking an IPO or something, it's probably even more like 10 or beyond. So it takes time. But going back to the data and, what you mentioned is kind of like building my portfolio. So one of the biggest reasons when I was looking at all of the angel investing data, venture capital data, I read all these books and podcasts and I was trying to say, okay, here's something that's very similar in a lot of ways, right? Investing in early stage companies. Now, yes, they're writing much bigger checks, but some of those lessons are still extremely applicable to be able to help, an equity crowdfunding investor who, is maybe investing $100 per company or $200 per company instead of 25K. And so what I did is after looking at all the data, being an engineer, I set up a bunch of models and I wrote some software programs to do Monte Carlo analysis. But basically what you find out, right, is that
nobody knows what that means.
Nobody even, I'm just throwing out buzzwords to be like, I did computer stuff. But all you need to know, right, is that when it comes down to like the mathematical returns, it benefits you in many ways to have diversification. And that's not only from a perspective of risk, which is definitely important, right? Because investing in any of these early stage companies, more likely than not, they're going to fail. If you look at the data, right, depending on kind of what data you're looking at and what stage they're at, but it could be 50% to 80% of companies, are probably not going to return the full 1x of however much money you've invested. So because of that, definitely important to, spread your bets. But in addition to that, so the real benefit that diversification gives you when constructing an early stage kind of mini angel portfolio, is that it's going to give you the opportunity to be a part of those, 1 or 2 businesses that end up having massive, massive returns. So, everyone's heard the stories. Yeah, right.
Yeah, I'm just letting everyone else know. I know that that they call that a unicorn. Yeah.
A unicorn, right? So a unicorn is a $1 billion. Any company is valued, $1 billion. And so, in the venture capital industry, the unicorns, right, are what everyone wants to invest in. Now that being said, as a smaller crowdfund investor, you can still be massively successful without even a unicorn, maybe a half a corn or, a quarter unicorn, right? So that would be something in the, say, 250 million or 500 million exit. The reason for that is that you're investing much earlier, even earlier than a lot of these traditional venture capital, funds would be investing. So if you're investing in an entrepreneur and it's, a $3 million or a $5 million valuation, if they have a $500 million exit, assuming no dilution, but that would be 100x return on your capital, right? From 5 to 500. So that's huge. And so the real key,
and you may need to explain what dilution means as well.
Yes.
So I'm going to write it down.
Please slow me down, right? So
keep going, and then we're going to explain some of these terms for people as
Perfect.
well. Go ahead.
And so the dilution, right, is when an entrepreneur raises one round of capital and they'll bring in some capital, they're going to then try to get to that next milestone, but eventually they're going to need to raise another round of capital, right? So it could be going from a seed round, which is really kind of early on, to maybe a Series A, which is maybe, when they're starting to get some more traction, some more sales. And then it kind of goes on Series B, Series C, and, all the way on and on. There's not really a kind of an ending to it. It's whenever they might eventually go public, if they went public. But all those series rounds just basically means the different rounds of private capital when investors are investing, where they're not going to be listed on a public exchange. That would be, like the New York Stock Exchange or the NASDAQ. So the reason the dilution is important, though, right, is that if I'm one of those investors in the very first rounds, at say $5 million, and for just easy math, let's just assume that a few years later they have an exit at a $20 million valuation, right? So that would be 5 million to 20. You think, oh, I get 4x my capital back, right? Because 5 times 4 is 20. But what actually happens is you actually have a slightly smaller piece of that pie at 20 million. So if you invested in, let's just say for, again, round numbers, that you owned 1% of the company at the $5 million valuation, what you would do is by the time that they were 20 million, they brought in more investor capital because they maybe did another fundraising round, another equity crowdfunding round, or venture capital round. And so what happens is that you get diluted because you own a smaller piece of that pie. But the hope is that overall that pie is getting bigger. So as a rule of thumb, when I'm thinking about dilution, if you're investing really, really early on at say a $5 or a $10 million valuation, by the time someone exits, 50%, is a really rough kind of quick number of the amount of dilution you get. So you can assume that, hey, instead of, the 1% that I own, I might only own 0.5% now, but hopefully whatever that exit value is worth more. So we're kind of getting into the math, but yeah, feel free to, if there's any other questions, if I say things, throw things out, I'm happy to, explain as we go along. So.
Absolutely. So, and I will say that dilution is not bad. It depends on the company. It depends on their strategy and what their goals are. So when we're listening to our Bet on Black pitches, we do ask, or we try to encourage you as the audience to ask, what are your plans for this company? And you have heard some people say, hey, our goal is to grow big and do an initial public offering or an IPO. Well, since they probably are going to have multiple capital raises so that you can expect potentially dilute, but you also are looking, is this going to, like Brian said, be a unicorn, be a half a unicorn, et cetera. And then there are other companies who say, our goal is to grow and to sell the business. And I know, so Brian, in our community, that is controversial, but, but that is a way that people will exit the business because as investors, we care about getting our money back. So we can get our money back through an initial public offering, meaning that the stock goes public. We can get it back because someone has sold the company. And there's a couple of Bet on Black pitches that we've heard that I think are going to be acquisition targets potentially at some point. So based on what they said, and if you think about it, a lot of big companies do not grow their stock price because they invent new things. They grow their stock price because they buy other companies. So sometimes within the Bet on Black pitches, you are listening for, hey, would Google buy this? Would Facebook buy it? You may think it's kind of some of these Fortune 5 companies like the Heinz Corporation, one day will do like a real assessment of some of these Fortune 500 companies that you're like, I thought they just owned ketchup, but no, they're a conglomerate. So sometimes our companies may be sold to some of these big companies like that. And then there are other ways that we get our money back as well. Sometimes the company intends to stay small, but they may do profit distributions, et cetera. So I know we have a couple of questions here. Brian, did you have anything to add to that, to the exit itself?
Yeah, so I think, you made a really good observation that in the different types of outcomes, right? Everyone, if you're talking kind of the venture capital speaker, a lot of, traditional kind of angel investors, it's all about the IPO, right? If you look at the data, I think it's something like 1% or maybe even less than 1% of all the companies will end up having an exit versus an IPO. So what Sharid was just saying there is extremely important, that, it's much more likely that, what your companies that you invest in will probably have an exit through an acquisition, a merger, perhaps, paying out dividends if they don't sell, that type of thing. So that's probably, the more likely outcome. And I did see, so there's one question over here in terms of crowdfunding.
One question in the chat, and we have a question in the Q&A. I don't know if it's the same. No, they're different questions. So we'll start here with Greg's question. in the chat. Can you elaborate on the difference between crowdfunding and a pre-IPO? Sorry.
Yeah, so really what you're talking about there is kind of two different things. So when you say pre-IPO, that really means anything that a company is doing prior to them having that IPO, the initial public offering. Now, when you kind of talk about that, the initial public offering, right, is basically when a company goes out and says, we're going to list on the NASDAQ or, the New York Stock Exchange, and they raise capital that way. That's a way of, a primary way of raising capital. So when you're talking pre-IPO, it's anything that happens before that. So that could be, again, kind of these rounds I was talking about, like the Series A, a seed round. It could be a private equity round. There's different things. And so crowdfunding is really one option for a company to raise capital in that pre-IPO stage. So in addition to crowdfunding, right, and you can raise capital from crowdfunding, but you could also raise capital from, friends and family, from traditional accredited investors, under something called Regulation D. You could raise capital, or you could just, do debt financing. There's a whole bunch of different financing options for entrepreneurs who are anything that's in that pre-IPO stage. So hopefully that kind of answers it. And sure, you feel free to chip in if I missed anything there.
Yeah, so, typically the crowdfunding that we do, which is the Regulation CF, typically tends to be the seed stage, which is early family and friend round, or Series A, which is like the level just above it. And then as the company matures, and actually CrowdWise is who helped us actually we licensed Brian's education. So we always give him credit for that and thank him for that. But one of the things that we show is as a company matures, then they go from family and friend to angel investor to venture capital to private equity funding. And each of those, it's a different animal, let's just say that. So with regards to your question, there may be some companies, Greg, that have just angel investors, maybe a couple of venture capitalists, and then they go right on to the stock exchange. Or others take much longer to get there, and they may have private equity put money in or other types of institutional funds within their businesses. So, but that's a really great question. Before I get to Trent's question, I also want to let people know, and perhaps Brian wants to come back for these as well, because he's super smart. He's much smarter than I am with regards to this type of investing. But during my vacation, I was researching, and many of you, if you were on the line before I went on vacation, we reviewed Jason Calacanis, he calls himself the GOAT of angel investing. GOAT stands for greatest of all time. So he has a book where he talks about going from $100,000 to $100 million. I purchased it. We are going to do book club with regards to that book. During my research on Amazon, you know how they always say, well, if you got that book, you might be interested in these others as well. I found another book called Startup Founders. And I don't know how technical it's going to be, but I'm going to delve into it, and we're going to do that as book club as well. The data scientists that wrote this book give data points with regards to billion-dollar companies. And they looked at, this is according to the jacket, I haven't read it, but I do have it. But they looked at the companies that went to billion-dollar plus unicorns, and they actually tracked data points from when they first got started to when they became billion-dollar companies. And these types of things can make us not only smarter investors, but I want our entrepreneurs that we're putting money into to also know these lessons as well, so that we can be smarter. So Brian, if you want to come and be a guest panelist on any of those, I will send you the link in a hot second so that you could come and chime in with regards
That's funny.
to that.
I'd love to. I was trying to look. I was trying to look in the background here. I was like, I know I have Angel somewhere on this bookcase, Jason's book, and then the Startup Founders book. I actually have that on my Kindle as well, so I haven't started it yet, but I will be reading that as well. So.
Maybe
So both
that's
books. Yeah. So Robin was asking. It's Angel Investing is the one by Jason Calacanis, and that's definitely a really good book. And then the other one is Startup Founders. Is that what it was, Sheree? I think.
Mm-hmm. Yeah, Startup Founders is by Ali Tomseb. That one happens to be on my bookcase. That's why I'm looking over. But Jason's book is actually in my bedroom, so that's why I don't have that here. But we'll make sure to put that in the newsletter, and this will probably be fall reading. I'll be honest with you, because we're pretty packed with guests now through the end of the summer.
Yeah. So I would love to just highlight how important, reading those books are, right? Because in something like early stage investing, where we already mentioned, the average timeline to invest is probably 5 to 10 years per company. That's a really long feedback cycle to have to wait that long to see, get feedback and be like, am I investing right? Like, do I have a good process, right? So how do you deal with that if you can't get feedback for your first investments in 5 to 10 years? And one of the ways is to read, some of these books by other investors, to read more about, startup founders, because while you yourself may not have invested, in these companies yet, there's definitely other people whose lessons that you can learn from. And stuff is not going to be identical, right? Like, obviously, history doesn't repeat itself, but it rhymes, those types of things. But I really think it's really critical that, you can kind of at least get some of the wisdom and the tips from some of these people, and then take it and apply it in your own way, because everyone's going to have their own investing style, their own preferences, their own types of, entrepreneurs they want to invest in. So take the lessons from those books and then kind of make it your own. And that's, what I've tried to do in my own investing as well.
Absolutely. So Trent had my next question, which is, what factors do you consider most when you are looking to invest in something? So why don't you take us through your process of, even finding out about the different types of deals that are available, what you look for, things like that.
Perfect. I'd love to. So at a high level, I look at 5 different areas, and, depending on which of the books you read, this, is not going to be reinventing the wheel. This will sound very similar. But I kind of just, for easy, like remembering it, kind of refer to as the 5 T's. But the most important one for me, again, is the team. So that's the founders and like those early employees. Now, the reason that I believe, and, a lot of people who are investors in early stage companies believe that's so critical, other than the fact that, they're going to be setting the culture, they're setting basically kind of the mindset of the entire business. They're really going to decide, is this something that they do want to bring to eventually one day come, to an IPO, or, are they happy with, a very comfortable business where they can still, kind of chug along and be happy and pay out good dividends to investors? Both of those are perfectly, great outcomes, but it just depends, which one that founder kind of wants to do for that business. So it's important to have an understanding of what that founder wants, though, because those are different outcomes for investors, right? Or they can be potentially. And in addition, one of the important reasons that team is so important is that, again, when you're investing in a lot of these companies who are in that, 2 million, 3 million, 5 million, 10 million valuation range, it's going to be the founder, maybe a couple employees, maybe a couple part-time contractors, maybe a co-founder or two. They're really, really small teams. And because of that, a lot can go wrong in the early days. It could be regulatory issues that no one could foresee. Someone could get sick. There's just so many things that you can't even think of. So why the team is so important is that you want to know that entrepreneur that you're investing in, when the times get tough, and not if, because we all know that eventually it is going to get tough, you want to make sure that person's going to stick through it and really carry through the idea. And maybe they have to pivot, right? Maybe the initial product they had or the service isn't going to work, but if you know that it's the right person, that's one of the most important things. So that's why I highlight team. I'll glaze over the other 4 so we don't dive really deep into them in terms of the other T's, but team, tech. So I call tech, which is technology, right? And I refer to that really as the product. So it doesn't have to be a tech, software as a startup SaaS business, but whatever that technology or that product or that service or that key offering is. If it's a local business owner, right? What is their secret sauce is really what I'm getting at, right? Like, why are they so passionate? Why are people going to want to go to their business? Why are they going to succeed? So team, tech, TAM, which stands for total addressable market. But you can just think of that as what's the overall market opportunity. Because again, it's just two different types of outcomes, and it doesn't necessarily mean one of these is right or one of these is wrong, but it could have different implications for investors. So for example, is this a business that maybe they want to open up, one or two local shops in town, but then kind of just stop there because they're happy, they're satisfying their customers, they have a good business for them. That's perfectly fine. In addition, in comparison to that, could be the company that wants to, build the $1 billion unicorn and have an IPO in the future, right? So that's two different kind of potential outcomes for investors in the future. So it's just good to know kind of what is the market that this founder, that this team is kind of targeting. And then in addition, so the fourth T is traction. And I really kind of define traction. It could be as, customers, do they have customers who are paying? Do they have interest if they're pre-revenue or pre-product? Do they at least have some proof that they're not just building something and hoping that people are going to show up and give them money, but what have they actually done to like validate that this is, a real business opportunity? And then the fifth one, which is very important, but I think a lot of people overlook it, is the terms of the deal. And the terms are very crucial, especially when you're investing in some of these online crowdfunding platforms, because there's so many different security types you got to get used to. There's a simple agreement for future equity, convertible notes, common stock, preferred stock, rev share, revenue share. There's all these different types of securities, right? And even then, if you have a safe on one platform and a safe on another platform, they aren't necessarily the same. You have to really understand what the terms are that you're investing in, because all the platforms kind of are different and have their own different takes in terms of how they set those up. So it's really important to know that. The biggest thing with most of the terms will typically be the valuation, right? So whether if it's a stock, what is the valuation of the stock? If it's a priced round, or if it's a safe or convertible note, what's that valuation cap? Which means it will eventually convert to equity. But that's good because that'll kind of give you a feel for, is this a reasonable expectation? Is this a reasonable valuation for a company that's in where they are compared to other companies who are maybe in a similar situation in terms of sales or different metrics you can compare them to. So those are the things I usually look for. But as a crowdfunding investor, it comes down to the team. And I'll be the first to admit it can be hard to assess the team as a small investor if you're investing $100, $200, right? Whereas if you were an angel investor writing a $25,000 check, I'm sure that that founder would probably hop on a phone with you in an instant, or even fly out to meet you potentially, right? Like that's what some of these investors would do, but it's just not the case anymore, right? Not only because of coronavirus, and I think a lot of the changes that has accelerated in terms of the industry, but it wouldn't make sense for the founders to meet and talk with every $100, $200 investor. So you got to find resources and ways to be able to assess those founders. And there's oftentimes they'll do a lot of webinars. I definitely recommend trying to find them when they're doing these investor Q&As. Take advantage of that because that's a great time to get to know them. In addition, a lot of the companies,
which is a bet on black pitch for us. Yeah,
exactly. And in addition, you can often find like some Q&A, right? So when someone has like a crowdfunding campaign, usually, there'll be some discussion with the founder and investors can ask potential questions. That's a fantastic place to learn how the founder, how that entrepreneur is thinking, how they respond to people, how they respond to tough questions sometimes, because, the investors aren't always, super friendly in how they might ask some of their really piercing questions, but you can learn a lot from the founder through that. So I put a lot of weight on that when I'm looking at making my own investments.
Yeah, and I want to go back to one thing you said. You mentioned the total addressable market and the team. And yes, it is true that you will have some people who say, I only want to build a couple of locations and then I'm done. And then someone else who says, I'm building the gajillion-dollar company. You do want to then circle back to the team and ask, do I believe that this founder can get this company to $1 gajillion? Because if that's not the case, then one of two things needs to happen. Number one is they will get to a point where they need to step aside as CEO and bring someone else on. Or number two, if, and I've seen this happen, they take the wrong person's money and the contract says that that venture capitalist can remove them as CEO and appoint their own CEO. I've seen that happen too, personally. So, you know, you do want to ask yourself, do I think that this CEO can go the distance? And there's nothing wrong with the CEO who says, look, I can grow the business to 20 million and then I need somebody else to step in who knows how to get it from 20 to 100 million. Because like Vicky said, more money, more problems. It's different problems. It's different getting a company from 0 to 20 million versus 20 million to 100 versus 100 million to $1 billion. Different problems. It takes a different type of CEO during each of those phases in business. But we do want to ask ourselves, if and when the CEO is out of, is not able to carry the company to the next level, whatever that is, are they going to be okay with either stepping aside or getting a strong number two that can help them, et cetera? So I'd love for you to chime in on that. And then we've got more questions here as well.
Yeah, you know, that's another excellent point that if you look at a lot of these like really famous companies today, you know, Facebook or Stripe or Amazon, those are exceptions to the rule where, you know, the original founder really sees them through everything all the way to the public offering and is still the CEO today. It's feasible, right? It happens. And there are people who can definitely make that
like
evolution.
5% of the time.
Yeah. But yeah, it's
yeah. Go ahead. I'm sorry.
No, sorry. I didn't know if you were going to say something else.
Okay.
So yeah, I totally agree. I'll leave it at that.
Yeah. We have the question of the industries that you tend to invest in. Now you're asking real estate, stocks, commodities, but we'll just keep a trend to the equity crowdfunding types of deals in industries that Brian tends to invest in. So yeah, tell us a little bit more about that. What do you look for?
And just to set the stage too, because, you know, if someone was as an investor looking to get started, you might wonder, you know, how much of my portfolio, you know, is right to invest in this. And what a lot of angel investors, I think even, you know, Jason Calacanis in the book probably says, is a lot of angels recommend usually starting around like 5% of your total, you know, investable assets. As kind of an upper bound. So that would mean you still have 95% of all your investments, you know, your retirement accounts, everything else in stocks, bonds, you know, traditional real estate. And you're only taking, you know, 5% of that capital when getting started to allocate to startups. Now, that's really important because, as we mentioned, the startups are very illiquid, right? So that means you can't trade it as soon as you buy it. If you need that money next year or a financial emergency comes up, you got to cover a medical cost in 6 months, you can't do it. So you don't want to invest any money that you're ever going to need, is how I like to think about it, right? You got to invest this and know that you're not going to see it for 5 to 10 years, if ever. So with that being said, how do I allocate the 5% that I do put into startups? Typically, I'm actually very industry agnostic. I kind of invest across, you know, all different industries. Now, that being said, you know, I think because of my technical kind of engineering background, I do really enjoy kind of typically it might be referred to as like deep tech or hard tech, right? So anything that is kind of a moonshot. So, you know, inventing new technologies, trying to, you know, figure out something with space flight or, you know, really, really hard stuff that's going to take a lot of capital and in all honesty is probably going to fail.
You're not risk averse at all.
Not a risk averse at all. I'm taking that small.
5% of my portfolio. So, and you're a young guy too. So you're like, look, I might as well go for it. Give me 10 unicorns. Is that what you're thinking?
So there's a portion of that 5% that is definitely that. But then a bunch of other 5%. I've invested in breweries. I've invested in clothing basically direct to consumer clothing brands. I've invested in everything you can think of pretty much. So really what I'm doing now, right, is when I try to look at a deal and say, is this something I'm interested in? There's usually something that catches my eye or that kind of piques my interest. And if you looked 3 years ago, there were probably maybe a dozen like crowdfunding offerings that were live at any one point in time. So you could easily look across, the entire industry and say, all right, I'm going to look at this basket and that one kind of looks interesting. That one does. I'm going to take those two. I'm going to do my deeper due diligence checks on that and then make an investment decision. Nowadays, there's hundreds. I think there's probably hundreds of deals right now that are live. So you can't do that. I can't, at least, don't have the time to go and look at every single deal. So usually, what I'm doing is I have a couple areas that I'm maybe like interested in investing in, and then I can look out for deals that come up within those interest areas. Or a lot of the times I'm actually getting active outreach from founders. I think you'll probably find this when you start having a LinkedIn profile. And maybe I've put my investments on Angel List. There's different tools where you can be like, hey, I'm an investor in this company and kind of make it public. Founders will see that and entrepreneurs will see that and they'll start reaching out to you. So honestly, sometimes I get some pretty interesting opportunities where the founder, the entrepreneur, has looked at my portfolio of investments and says, hey, I saw you invested in company A, company B, company C. We're doing something similar in this industry. Here's our pitch deck. We're raising on this platform. Check us out. So that's another good way and a recommendation I would give you that you can do to help yourselves to be able to cut down, some of the legwork that it takes to get your deal flow is start making your investments public. And then people will start reaching out to you via email, via LinkedIn, all these different channels. So that's a really good resource that I use today.
I love that. And Tawana thanks you as well. So I'll make sure she does that. So Kevin asked here about your portfolio. How many exits have you had?
Great question. So I'll be fully transparent too. So, I started this, I technically made my first Regulation A investment back in like 2014, but my first Reg CF, which is that crowdfunding where you can, raise up to 5 million now. I made that it was probably late 2017. So my earliest investment that I've made is still, barely 3.5, 4 years old now. So because of that, I wouldn't really have expected within that timeline to have had many failures or exits yet, maybe more failures, but definitely not really any substantial exits. But that being said, I've had a few. Now, most of my exits have been relatively small, but mostly positive, I will say, surprisingly. So more of my portfolio has actually had a follow-on financing round that would convert. So if I invested in a convertible note or a SAFE, that simple agreement for future equity, some of those early companies have gone on to raise a Series A round. So I've had a handful of SAFEs and convertible notes that have now converted to equity. But of my ones that have actually had an exit, I think there's been about 3 to 4. And again, but most of those were the ones that I invested in kind of that 2018 timeframe, probably. So they're like 3 years-ish old. And a few of them, yeah. So one of them was actually a repurchase, which means that the founding team basically bought out the early investors. So I made 1.5 times my money on that. You might think, wow, that's great, because that was actually a pretty quick one. Surprisingly, that's actually a bad outcome in that situation. And the reason is that company was probably one of the best companies on paper. And they bought out their early investors because they knew they were doing so well. So one of the deal terms, basically, right, that would be like if you invested in Facebook's first round, but then Facebook buys you out for 1.5 times your money during their Series A. You don't want to get bought out when you're in a really good investment. So that was a good lesson for me. And one I'll share here is that one of the things I look for in my deal terms now is that there's no repurchase clause. It basically means that the founders, at their option, can buy out the investors, and they'll say something like fair market value. But when this company, I'm not going to get into the details, right? Because I'm still a big supporter of the company, but is not as good of an outcome as it could have been for investors.
Share. No, I'm just kidding. we can fill in the details, but yeah. So I would imagine, like you said, that companies or early founders wouldn't do a repurchase unless they knew they had something and they've got the available cash to be able to do it. So, yeah. So a couple other questions here. And then Charmaine, your hand is up. If you mean, if you mean for your hand to be up, let me know. Put it in the chat. I apologize for the dog here. Angela is asking, how do you track all of your investments?
That's a great question. So I started out, and honestly today still use basically a big Google sheet. So, like a spreadsheet, and it has kind of evolved over time. But the main things I track, right, are the company, the date that I invested, the amount that I invested. And then one important thing, this is actually a fantastic point, because I think this is super extremely critical, for anyone looking to kind of get into early stage investing, is I wrote down my original thoughts of why I invested, what are the good things I saw in the company, and what are the potential risks. Now, the reason that becomes so crucial is that, as we were saying, most of these companies, aren't going to fail or have an exit for 3, 5, 7+ years. If you're trying to improve your own investing process, and then 7 years down the road, one of your companies has an exit, you're probably going to pat yourself in your back and be like, wow, I made a really good decision. That was a good investment decision. But the most important thing you can do is go back and look at that kind of spreadsheet that you kept and be like, why did you invest in that company? Because what you may find is that that company might have been successful for something that wasn't even on your radar. Or maybe they failed for something that wasn't even on your radar. And that's a great way to be able to improve your investment process. Honestly, without hindsight bias, right? If you're trying to go back and recreate in your head, like, oh, I think I invested at the time, it was a good reason because of this, you're going to be blurred. It's not going to be the truth, right? So put it down in a spreadsheet at the time you make the investment, and then you can go back to that and look at it. So when they, raise a next round of capital, if they do that, or if they have a good exit, or if they fail, go back and then ask yourself, okay, what did I do right? What could I have done better? And then start using that to improve your process moving forward. So I do use a spreadsheet to track my investments. In addition, so I actually created my own tool for this reason, actually, because it was so hard after a certain point when you get, 100+ investments in a spreadsheet. You have convertible notes that are converting to equity. You have companies that are failing. A spreadsheet is just hard to continue to manage all of that. So I created a portfolio management tool called Venture Wallet at venturewallet.co. And that was basically just something I created for myself to be able to keep it kind of in more of an app form, right? So you can add any investment you want, put a whole bunch of different details about when you invested. And then eventually I have a whole bunch of features I'm looking to build out to do basically supplement some of the different things for that, to be able to help people with your process, right? So when you're screening deals, I think it's important to not only capture those companies that you're choosing to invest in, but you should be capturing those companies you're choosing not to invest in, because it's kind of referred to as the anti-portfolio. Sometimes you may find like venture capital firms or different people who will show their anti-portfolio, which basically means we had a meeting with this company, they wanted to invest, but we chose not to. It can be good because that can show you blind spots. And kind of go back to what Cherie was saying, like, I think human psychology and just understanding how your brain thinks and, all of that will impact your investment decisions in the investment process. So it's really, really critical to have a good handle of that.
Right. I mean, look, I love hearing about the companies that people like Mark Cuban and Kevin O'Leary, who are supposed to be the smartest guys in the room, didn't invest in, or they tried to strong arm the entrepreneur, and the entrepreneur ended up winning out in the end without their investment. So of course, those are probably people from Shark Tank, but there are some other well-known investors who passed on Uber and things like that. And when they talk about it, you're right. It would be interesting to document our journeys and ask ourselves, what did we pass on and why did we pass on those entrepreneurs? So Trent has another question in here. What resources would you recommend to learn investing?
Yep.
Learn about equity crowdfunding investing.
Yep. So again, I would reiterate some of the books we already talked about. Angel by Jason Calacanis. There's another one called Angel Investing by David Rose. Now those are based on angel investing, but again, most of the stuff, other than the check size, which will be 25,000 or whatever, but most of the other stuff in the books is very applicable. In addition, there's some, I'll say, it's not specifically investing books, but I think have really, really good lessons for investors, especially investors in startups. One of those books is Thinking in Bets by Annie Duke, which she was basically a world-class professional poker player. But she talks about, this is going right back to what we were just talking about, your investment decision log is trying to quantify, the outcomes, or separate the outcomes from the actual decisions themselves. So you could have made the best possible decision at the time, but it has a bad outcome. And you might think at the end, because it ended badly, that you made a bad decision, but that's not true. And vice versa. You may have something that has a fantastic outcome, but you made a bad decision that kind of, was a fluke and ended up leading to that. So it's really important to understand, I think, the kind of correlation between the decisions that you're making and the outcomes that you're getting. And you have to understand that there's always going to be a portion of that that's attributable to luck. Especially with these early stage companies with founders, there's so much that can happen. There's a portion of it that you just have to understand is going to come from luck. And so that book was fantastic for that. Another book that I really enjoyed is Anti-Fragile by Nassim Taleb. And basically what the premise of the book is that you understand what fragility is, right? So fragile, anything that's kind of, if you drop a glass and it breaks, anything that's basically, if you have an input or an uncertainty, it makes something weaker. Anti-fragile is something that not only is robust, that would kind of survive, but actually get stronger due to uncertainty. And that actually has a lot of kind of applicability and lessons, again, in the space of startup investing. He talks a lot about, he also wrote the book, The Black Swan, which, people may have heard of, kind of about the long tail and, black swan outcomes. So all those theories, though, are very applicable, I think, in the startup investing space. So in terms of books, that's all great. There's a lot of great resources. I mean, obviously the 10K project, please, they are putting together a whole bunch of fantastic, webinars, material, everything else. So take and consume all that you can from them.
Yeah, thank you for your part in that as well.
Thank you. And then, so Crowdwise is my own, business that I've put together that's entirely free. All the investor classes and resources and everything I have there is basically trying to share my own lessons with investors. There's some good podcasts out there as well. I mean, again, going back to Jason Calacanis, there's one called This Week in Startups, where he interviews founders just every single episode. So you get to hear about businesses from all different industries and get to hear, questions that investors might ask, and then things that the founders are dealing with. So that can give you some really good insights. So yeah, I would, and in addition, I would just say, try to, join some groups, join some communities like the 10K project, where you have other people who have similar goals, where you can learn along with them and share your ideas and thoughts, because it's really through that collaboration and discussion that, I think you will get a lot of value added. So I would definitely recommend that.
Right. I'm a big fan of, and I apologize, my house must be like the noise central right now, but one of the things that I do is I will just watch random YouTube videos. I'm not really on Facebook or other places like that, but whatever your favorite social media is, of just things that are trending in different industries, even if I'm not in the industry at all. So, there may be a 3-minute segment on a new type of robotic that's coming, down the pipeline, or something happening in AI. I barely listen to this guy's podcast, but I'm subscribed to him on YouTube. And now AI, they are training it to smell and to feel physically. And I would not have known that had I not just been subscribed. I hadn't even listened to what the guy, like his podcast, but he brings these guests on that talks about different functions of artificial intelligence. And I'm like, what do you mean AI can smell? But this is what they're building, So just even staying in tune sometimes with some of the trends that we see. I'm also a big person on economics as well. So there are different schools of thoughts about labor shortages that are expected, and also ways that the 1% are trying to finagle things so that if there's a labor shortage, that means that people's wages go up. And the 1% doesn't want that. So they're doing certain things within the economy in order to have a labor surplus. So, these are the types of things, again, that I listen to as well, just so it can make me a smarter person. And then when I'm hearing things as an investor, I can say, oh, yeah, I know blah, blah, blah is happening over here. That makes sense. So I don't know how you feel about that.
I love that.
Brian.
I'm 100% behind everything you just said, Sheree. I mean, right, even as like entrepreneurs, I think where a lot of innovation comes from is cross-pollinating of ideas, right? And a breadth of knowledge. Not like, there's definitely areas too where depth of knowledge is very, very important and getting specialized in one thing. But often the innovations that you'll kind of see are, taking some little thing that you learned over here and this completely disjointed thing that you learned over here, and then putting those together in a new way. That's what innovation is. So I think that by keeping track of all the different trends, it can help inform your, investment trends. Like, it's obviously important to know from that reason, but also can kind of give you different ideas about different business models and, whether something might make sense and whether something might actually have potential value in the future. So I love that.
So then I have two final questions for you. The first is, in your analysis, your econometric analysis, is there a certain number of equity crowdfunding deals that you suggest people get to really feel like they're diversified? You know how they say, put your money in the Fortune, what do you call it? Not the Fortune 500. Yeah, Fortune 500 stock index, and that's like a good diversification. I'm just curious if there's a number.
Yeah, so pinpointing an exact number is hard for two reasons. Is one, again, equity crowdfunding is still so new that we don't really have real good data about the potential exits, but assuming that it's going to follow a similar trend to angel investing and venture capital, what many people will tell you is 20 is probably kind of reaching that minimum bar of like, this doesn't mean you need 20 on day one, but building up to a portfolio of about 20 investments at least is giving you, some good opportunity. Because again, if you're looking at, say, a 70 or an 80% failure rate, that's 8 out of every 10 of your companies are going to go to zero or return less than 1 times. And so you're only getting a shot of 1 or 2 out of every batch of 10 that you invest in to get good returns. So by doing more and more companies, you're giving yourself some, exposure to more of those potential outliers for positive returns. So I did run some different kind of models and, predictions based on data that WeFunder had a couple years ago. And from that, based on, their size of investments, it was getting closer to 50 to 100 long-term if you want it to be really well diversified to have like really good returns. But, that being said, the startup investing space is very interesting because your mean return will actually go up the more companies that you invest in. It's kind of counterintuitive. I'm not going to get all into the details because I will even, probably misspeak myself, but AngelList did some really good studies of this based on all their data set of startup investments. And AngelList is an accredited investor platform for those who don't know, but they have tons and tons of like thousands of deals that have, been over the course of 15 to 20 years now. So they can kind of do some really good analysis. And what they found was that, yeah, the more companies that you invest in and diversify, the higher your expected return, which is kind of, almost counterintuitive because you're usually like, diversification is good for risk. But, if you kind of concentrate into a few really good companies, you would expect that would outperform. But the thing with startups, right, is that there is just so much more uncertainty. It's so much earlier that The companies, no one knows. That's what it comes down to, is no one knows the future. No one can tell you which of these companies is going to be, the next one that's a unicorn. So when no one knows, the best you can do is just try and give yourself the best odds of investing in that unicorn with a small amount. So I would say that, though, for people
Right.
just getting started, pace yourself, right? Be patient. There's always going to be more deals coming. And I'll be honest, like when I was looking at deals the first time, every single founder that you hear, an entrepreneur, is going to be selling you the next best solution that the world has never seen, right? Because a lot of them believe it, and a lot of them are working on great things. But you need to be reserved, be patient, invest very, very small amounts to start. Just get enough to get some skin in the game so you can learn. And then as you get more comfortable, you can start kind of increasing a little bit if you want to increase that. But I would try to aim for like that kind of 20 as a minimum threshold for a portfolio. And then, maybe you can kind of increase it from there, or, keep it as 20. And as you have some exits in future years, you can continue investing. So.
Absolutely. So, I mean, that's a really good target. So one of the things that, I think about is this is an asset class, just like you may have real estate as an asset class within your portfolio, or tax liens, or stock options, or any other types of investments that are available to you. And yes, you want a small portion of your total investable income in this asset class. But then once you get here, and I'm not saying this for selfish reasons, I am saying it because it's important to you as well as the entrepreneurs. Now we want to start thinking about, okay, let's be here for 3, 4, 5 years, coming to the Bet on Black pitches or watching the replays at 2 times speed, finding the ones that you like, and coming up with a real portfolio of 50 to 100 minimum that you like. And by doing that, we're hearing Brian say, based on his models and best practices from the industry, then you should do good and do well, Trent. So I saw your note in there about you feeling very emotional, and I do as well. So I will invest based on emotion, even though I kind of have to still believe that there's something there
Mm-hmm.
with the company. But I have a certain amount that I put into every company, and it's like dinner, or like a really good dinner, with friends. So and
That's a
it.
great way. And honestly, I'll just share, like, from my own, a few of my best investments right now. If I go back and look at the reason why I invested, one of them I invested purely because of the perks. It wasn't because I thought it was going to be a great success. It wasn't because I knew that, it was the next, whatever, Tesla or a company, but I invested because I liked the perks and I thought it sounded cool. And you know what? It turned out really well. So it just goes to show, you can't really tell early on. So have fun while you're doing it, right? Like, do it with good intent, do it with wanting to do good in the world, but make sure you're enjoying it too, because it should be a fun experience and process.
Absolutely. So tell everybody where they can find you, connect with you, the CrowdWise course as well, which we do recommend. Any final points for the family that you want them to know?
Yeah, thanks. So yeah, you can find all our courses and community over at crowdwise.org. And basically 6 hours of free startup investor courses, kind of walks you through everything through, getting started and the diversification, some courses that even get more into the math, that we were kind of alluding to tonight, if you're interested in that. But also, just talking about how do you screen companies? How do you do a valuation? What are the different types of, valuation of early stage companies? And then in addition to that, just lots of content in terms of, industry metrics, how the overall industry is doing, what the different trends are. There's kind of a lot going on right now, and so I think it's a pretty exciting time to be in the industry. But then yeah, so in terms of myself, you can find me there, and I also will be on social, so you can find me on Twitter or Facebook as well, Crowdwise, or look me up, Brian Belley. Connect with me on LinkedIn. I'm always very, very excited and happy to connect with fellow investors or entrepreneurs or founders or anyone else. So please send me an invite, kind of let me know you are here tonight, and I'll be glad to connect.
Fantastic. And next week is Dr. Cherie Phillips is coming back to give us our quarterly economic update. So we will be here next Monday. Okay, everybody, thank you so much. Have a wonderful week, and we'll see you next week. Take care. Bye-bye. Thank you, Brian.
Everyone. Thanks, Cherie.